Hey everybody, how's it going? Ron Sneller, owner and president of Sneller Financial Services, coming at you today. I thought we would just change up the scenery a little bit, spread out, go into the conference room, give ourselves a nice new little look and feel to this video series. So today we are going to get started with video series number 6 in the 7 deadly sins of retirement planning. Mistake number 6 is about mistakes with insurance. And I know that people don't like talking about insurance and thinking about the bad things that could happen in life. But in general, people are woefully underinsured. It's unfortunate, but time and time again, I find it to be true. So let's start with the area that I think is most important: protecting your family with life insurance. I think people should buy term life insurance equal to their human capital equivalent value. What the heck does that mean? Well, I mean that they should insure themselves for their full earning potential. So for example, if a 45-year-old is making $100,000 per year and they plan on retiring at age 65, so they're going to work another 20 years, $100,000 per year multiplied by 20 years, that's $2 million. For the rest of their working career, they're going to earn $2 million. And so they should have $2 million worth of term life insurance. If you're 55, you should have 10 years worth of salary. And if you're 35, you should have 30 years worth of salary. I always find it interesting when people try to shortcut their life insurance, of all things. This is about protecting your family by replacing the full amount of income that you would earn to support them. This is about making their dreams come true, whether you're here to see that or not. As a working father or mother, or as a husband or wife, you are the ATM machine for your family. Your ability to work or earn income, that means that you're going to generate cash flow to support them throughout your working career. Now let's think of other forms of insurance. How much do we insure our homes for, or our cars for? Full replacement value, that's how much. Do you ever hear people shortcut their homeowner's insurance by saying, well, my home is worth about $400,000. I've got $200,000 in my 401k, so I'll just insure the home for $200,000. And then God forbid, if it burns down, my 401k can take care of the rest. Save a little bit of money on my homeowner's insurance. No, that's ridiculous. They place coverage for full replacement value on their home. And they do this even once the mortgage is fully paid off. Now, do you ever hear people shortcut on their auto insurance by saying, well, I've got $30,000 in the bank in case my car gets totaled, and my IRA can pay for any lawsuits that might come my way if I'm the one who causes the accident and gets sued? No. We insure our things for full replacement value. Why not our life? Why not our earning potential? Which one is more important to our family? Life insurance can create millions of dollars of capital out of thin air in case the worst of the worst happens in life. God forbid, if your family is struggling through the loss of you, don't make your spouse wonder, how are they going to retire? How are they going to pay the mortgage? How are they going to send the kids to school or college? And how soon they'll have to return to work to do all of these things. Now, that's in term. Also, look at converting the term into permanent life insurance. Cash value life insurance is a great non-correlated asset class. These policies generally grow 3 to 5% income tax-free with no market risk, and they can be used for tax-exempt cash flow during your retirement years. And in the meantime, I'm protecting my family with a policy that's guaranteed to pay us some kind of benefit. In addition, permanent life insurance can be a key piece in a pension maximization strategy and even to protect or replace Social Security benefits. And I just wanted to touch on that here because that strategy could be subject to its own video. But just know that that's a key retirement planning concept for a lot of people. Now, even if you are single Who's going to protect your retirement plan if you become disabled? There's no disability protection on a 401k. If you can't work, then you can't earn. And if you can't earn, then you can't contribute to a 401k. And just because you're disabled doesn't mean that you won't need money after the age of 65. You can add a disability waiver of premium to your cash value life insurance policy. So if you do become totally and permanently disabled, the insurance company is going to fund that part of your retirement plan for you because they pay your policy. Now, speaking of disability, when was the last time you reviewed your employer's workplace policy? Do you understand the benefits? Have you maximized the benefit through purchasing a supplemental policy? If not, could you really live on half or less of what you're earning right now in the event of a long-term disability, in the event of a long-term illness, in the event of a long-term injury? This is a critical consideration during your working years. Also of note, many permanent life insurance policies have chronic illness or long-term care benefits that will actually allow you to spend your death benefit while you're still alive if you end up going into a nursing home. Now, speaking of long-term care, do you realize that according to both the U.S. Department of Health and Human Services and AARP, that there is a 60 to 70% chance that a person will need some form of long-term care before they die? You know, full-time nursing home care on average is $90,000 per year here in America. Now consider that the average stay in a nursing home for a man is 2.2 years. For a woman, it's 3.7 years. Multiply that by $90,000 per year. Now attempt to factor in the skyrocketing cost of medical care, which increases at a much higher rate of inflation than everything else. What's that going to look like in 20 years, 30 years, 40 years? Not pretty. No wonder that most long-term caregivers are not professionally licensed. You heard that right. Most long-term caregivers are not professionally licensed because it's family. Due to the cost, families try to take care of mom and take care of dad, many times ruining their own health, their own finances, and ruining family relationships in the process before finally putting mom and dad into a nursing home anyway as a last resort. Don't believe me? Here's a homework assignment. As an aside, I'm a former teacher, so I love homework assignments. So now my career has simply transitioned into financial and retirement education. So here's a homework assignment. What I would like you to do is I would like you to go into any assisted living facility or nursing home, find the nicest family there, and I want you to ask them just 2 questions. Number 1, how are the finances working out? And number 2, how are all of the brothers and sisters getting along? You know what you're going to find? Number 1, the finances are not working out. And number 2, I've been in this business long enough to know that there are people watching this video right now where some of the brothers and sisters are not talking to some of the other brothers and sisters because of what happened with mom or what happened to dad. Long-term care can rip families apart, and I don't want that to happen. Proper planning can help to avoid all of that. Long-term care can wipe you out financially, and it can destroy family relationships. But you can avoid many of those issues by simply transferring the risk over to an insurance company. Now, the brothers and sisters don't have to worry about the cost. They don't have to feel guilty about depleting mom and dad's assets. They don't have the added responsibility of paying out of their own pocket. They don't need to worry about taking time off of work or rotating shifts between family members to provide care. Now they can go out and hire professional assistants and even round-the-clock care if necessary. And guess who pays for all of that? The insurance company. And this is what I have found. The children who are caring for mom and dad, they hate spending their own money, and they really hate spending mom and dad's money. The fact that they might have to deplete mom and dad's retirement account or assets to pay for this kind of thing, they absolutely hate it. But do you know whose money they love spending? They absolutely love spending. If you guessed the insurance company's money, you're absolutely right. They love spending the insurance company's money. So if there is a long-term care insurance policy in place, the children, they will utilize that money to take care of mom and dad and get mom and dad the kind of professional care that they need. Now, when we're talking about this, I want you to simply realize that for pennies on the dollar, a family can purchase peace of mind, security, and knowing that your loved ones will be taken care of. In Research Your Options, insurance companies are innovating incredible types of programs to deal with this immense and ever-growing long-term care burden. There are even life insurance policies and annuities that have long-term care benefits attached to them. There are also standalone long-term care insurance programs where if you buy the right kind of policy, guess what? All of the care can be done from the comfort of your very own home. That's right. You could buy long-term care insurance with home health care. It's what I've already purchased to protect my family. So this kind of policy, this isn't about nursing home insurance. This is anti-nursing home insurance. It's stay in your home insurance, stay in control insurance, maintain your dignity insurance. I encourage you to take this risk seriously and plan ahead for it by transferring the risk to an insurance company in one of the ways that I've discussed. Not having long-term care insurance can be the single biggest devastator of your financial plan. Now, I know it sounds like I'm exaggerating, but I'm simply quoting a CNBC.com article from October of 2019. You think long-term care insurance is expensive? Try not having it. At the end of the day, this is about your life, your financial plan, your retirement, your happiness, your security, your enjoyment. You work so hard to build it. And if it's worth building, isn't it worth protecting? Thanks for tuning in to video number 6 in the series. Please feel free to contact me for a complimentary appointment. And don't forget to check out the final installment in this series, Deadly Sin number 7, No Strategy for Taxes. Thanks for tuning in.